Eli Lilly is printing money. Revenue is surging, margins are expanding, and its obesity and diabetes franchises are becoming some of the most powerful growth engines in the entire pharmaceutical industry. Wall Street loves the story. The stock has massively outperformed the broader market, investors are chasing the growth, and Eli Lilly is now being valued like one of the most dominant businesses in healthcare. But here's the question serious investors need to ask. When a company becomes this successful, how much future growth is already priced into the stock? Because great businesses can still become risky investments if expectations rise faster than fundamentals. So in this video, we'll break down Eli Lilly's business, growth drivers, competitive position, financial performance, and most importantly, whether the stock is still reasonably valued, or whether the market has become too optimistic. Valuation is one of the most important concepts in investing. Because no matter how great a business is, every investment still depends on the price you pay. A company can have strong revenue growth, excellent management, powerful products, and dominant market positioning. But if investors pay far beyond what the business can realistically deliver in the future, future returns may become very limited. That is why valuation matters. Valuation helps investors estimate whether market expectations are reasonable, too pessimistic, or overly optimistic. It creates a framework for understanding risk, reward, and potential future returns. And most importantly, valuation helps investors separate the quality of the business from the price of the stock. Because a great company does not automatically mean a great investment at any price. For example, a stock trading at $100 is not automatically cheaper than a stock trading at $1,000. What matters is earnings power, growth potential, cash flow generation, profitability, and the expectations already priced into the valuation. That's why professional investors spend enormous amounts of time analyzing valuation. Not because they can predict the future perfectly, but because valuation helps them make more rational investment decisions. And for a company like Eli Lilly, where growth expectations are already extremely high, understanding valuation becomes even more important. Now that we understand why valuation matters, the next question is, what exactly is fair value? Fair value is the price a stock reasonably deserves, based on the company's financial performance, profitability, growth potential, and overall business fundamentals. In simple terms, fair value represents what investors may consider a reasonable valuation for the business today. It is not simply based on market emotion or short-term price movements. Instead, it reflects how the company is actually performing financially. For example, companies with stronger earnings growth, higher profitability, better cash flow generation, and stronger competitive advantages typically deserve higher valuation multiples from the market, while companies with slower growth or weaker fundamentals usually trade at lower valuations. That's why fair value is important, because it helps investors understand whether a stock price appears reasonable, too expensive, or potentially undervalued relative to the company's actual business performance. And in the case of Eli Lilly, the key question is whether the company's extraordinary growth is strong enough to justify its premium valuation today. Now let's talk about how to read these valuation slides. Because valuation is not about finding one perfect number. It's about understanding different possible outcomes based on different assumptions. In this analysis, I use several valuation scenarios ranging from conservative assumptions to more optimistic market expectations. The conservative case assumes slower growth and lower valuation multiples. This scenario helps us estimate downside risk if market sentiment weakens or growth begins to normalize. The base or historical scenario reflects valuation levels that are closer to the company's long-term average. And finally, the optimistic scenario assumes the market continues assigning a premium valuation due to strong growth expectations. By comparing these scenarios, we can better understand potential upside, possible downside, and how sensitive the stock price is to future expectations. And this is important because stock prices are driven not only by current earnings, but also by what investors expect the company to deliver in the future. So when reading these slides, don't focus only on the target price. Focus on the assumptions behind the valuation. Because in investing, expectations often matter just as much as fundamentals. Founded in 1876, Eli Lilly and Company is one of the oldest and most respected pharmaceutical companies in the world. But over the past few years, Lilly has transformed itself from a traditional drug maker into one of the fastest-growing healthcare companies on the planet. Today, the company operates across several major therapeutic areas including diabetes, obesity, oncology, immunology, and neuroscience. However, the real engine behind Lilly's explosive growth is its metabolic health business, especially its blockbuster GLP-1 drugs. Mounjaro for diabetes and Zepbound for obesity treatment. These products are not only generating billions of dollars in revenue, they are fundamentally changing how obesity and diabetes are treated worldwide. And unlike many pharmaceutical companies that rely heavily on older legacy drugs, Lilly is entering a completely new growth cycle driven by innovation and massive global demand. What makes Lilly especially powerful is the combination of strong pricing power, high recurring demand, massive manufacturing expansion, and one of the most promising drug pipelines in the industry. In many ways, the market is no longer valuing Lilly like a slow-moving pharmaceutical company. Instead, investors are beginning to treat it more like a high-growth platform business inside healthcare. When discussing the global diabetes and obesity market today, two companies dominate the conversation: Eli Lilly and Company and Novo Nordisk. For years, Novo Nordisk was the undisputed leader in diabetes care through blockbuster products like Ozempic and Wegovy. The company built a massive global presence, strong physician relationships, and one of the most trusted brands in metabolic healthcare. But over the last 2 years, Eli Lilly has started to shift the competitive landscape dramatically. The biggest reason is efficacy. Clinical data suggests Lilly's Mounjaro and Zepbound may deliver greater weight loss and stronger glucose control compared to Novo's leading products in several patient groups. And in the obesity market, better outcomes matter enormously. Because if patients lose more weight, physicians prescribe more, insurance providers become more interested, and long-term adoption accelerates. Another key advantage for Lilly is product momentum. Right now, Lilly is rapidly expanding manufacturing capacity, global distribution, and insurance coverage. The company is investing billions of dollars into new production facilities because demand is simply overwhelming. Meanwhile, Novo Nordisk still maintains major strengths: strong international reach, first-mover advantage, and an extremely powerful brand in diabetes treatment. In many countries, Novo products remain deeply embedded within healthcare systems. So this is no longer a simple winner-takes-all story. Instead, the diabetes and obesity market is becoming large enough for both companies to generate enormous long-term revenue growth. However, from an investor perspective, the market currently views Lilly as the more aggressive growth company, especially because of its faster revenue acceleration, stronger recent earnings momentum, and next-generation obesity pipeline. In short, Novo Nordisk created the modern obesity drug market. But Eli Lilly may now be taking the lead in the next phase of the GLP-1 revolution. In Q1 2026, Eli Lilly and Company delivered one of the strongest quarters in the entire healthcare sector. Revenue surged to nearly $20 billion, up approximately 56% year-over-year. That level of growth is extremely rare for a pharmaceutical company of Lilly's size. Adjusted earnings per share came in at $8.55, massively above Wall Street expectations. Net income more than doubled compared to the same quarter last year. And once again, the main growth engine was GLP-1. Mounjaro generated approximately $8.7 billion in quarterly sales, growing more than 120% year-over-year. Meanwhile, Zepbound added another $4.2 billion, showing explosive adoption in the obesity market. Combined, these two drugs alone produced more than $12 billion in just one quarter. What makes this even more impressive is that Lilly achieved this growth despite pricing pressure in several international markets. Volume growth reached roughly 65%, which more than offset lower realized prices globally. This tells us demand remains extraordinarily strong worldwide. Profitability also remained extremely healthy. Gross margin stayed above 80%, demonstrating the massive operating leverage of Lilly's business model as revenue scales higher. And because of this strong momentum, management raised full-year guidance again. Lilly now expects full-year revenue between $82 and $85 billion, and adjusted EPS between $35 and $37. But perhaps the most important takeaway from this quarter is this. Lilly is no longer dependent on a single growth product. The company now has multiple blockbuster drugs, a rapidly expanding obesity platform, international expansion, and one of the deepest pipelines in large-cap pharma. That combination is what makes the market increasingly value Eli Lilly not just as a pharmaceutical company, but as a long-duration growth business. The market reaction to Eli Lilly's Q1 2026 earnings was explosive. After reporting another massive earnings beat, Lilly stock surged nearly 9% intraday, adding tens of billions of dollars in market value within hours. Investors were impressed by three major things. First, revenue growth of 56% year-over-year. Second, another huge beat on earnings per share. And third, management raising full-year guidance once again. But perhaps the biggest reason behind the rally was confidence. The market is beginning to believe that Lilly's obesity and diabetes business may be much larger, and more durable, than previously expected. Mounjaro and Zepbound continue to dominate prescription growth, while Lilly's next-generation obesity pipeline is getting stronger. Investors are also becoming increasingly optimistic about oral GLP-1 drugs, which could dramatically expand the total addressable market by attracting patients who dislike injections. Another bullish signal came from Lilly's aggressive manufacturing expansion. The company recently committed billions of dollars to increase production capacity in the United States, showing management's confidence in long-term demand. And compared to competitor Novo Nordisk, Wall Street currently sees Lilly as having stronger momentum, faster earnings acceleration, and potentially the more powerful next-generation obesity platform. Of course, not everything is perfect. Some investors remain concerned about valuation, pricing pressure, and whether competition could intensify over the next several years. But at least for now, the market is sending a very clear message. Eli Lilly is no longer being treated like a traditional pharmaceutical company. It is being priced like one of the most important long-term growth stories in the entire healthcare sector. Now, let's take a look at a small portion of Eli Lilly's financial ratios for fiscal year 2025 and 2024. Starting with gross margin, Eli Lilly delivered an outstanding 83.04% gross margin in fiscal year 2025, improving from 81.31% in fiscal year 2024. This increase may look small on the surface, but for a company generating tens of billions of dollars in revenue, even a modest margin expansion is extremely significant. The improvement reflects stronger product mix, especially from high-margin GLP-1 drugs like Mounjaro and Zepbound, as well as increasing operating scale. Next, let's look at return on invested capital, or ROIC. Lilly's ROIC surged to 35.32% in FY 2025, compared to 26.47% the year before. That is a massive improvement. A ROIC above 30% places Lilly among the highest quality businesses in the market today. It shows the company is generating extraordinary returns from every dollar invested into research, manufacturing, and expansion. Now moving to free cash flow margin. Lilly's FCF margin jumped dramatically to 21.57%, up from just 12.88% in FY 2024. This is a very important signal for long-term investors, because it means revenue growth is now translating into real cash generation at a much faster pace. The company is becoming not only larger, but also significantly more efficient financially. And finally, interest coverage improved to 28 times, versus 17 times in the previous year. This indicates Lilly has very strong financial flexibility and minimal balance sheet stress despite aggressive investments in manufacturing expansion. In short, Eli Lilly is not just experiencing explosive revenue growth. The company is simultaneously improving profitability, capital efficiency, cash generation, and financial strength, which is exactly what investors want to see from a long-duration compounder. So, what could continue pushing Eli Lilly higher over the next several years? The first and most important catalyst is the continued expansion of the global obesity market. Worldwide obesity rates continue to rise, and many analysts believe GLP-1 drugs could eventually become one of the largest pharmaceutical categories in history. If adoption continues accelerating, Lilly's addressable market could be far larger than what investors currently expect. The second catalyst is international expansion. Right now, obesity treatment penetration remains relatively low outside the United States. As more countries approve reimbursement coverage, Lilly could unlock a massive new wave of demand globally. Another major catalyst is oral GLP-1 development. Today, most obesity treatments require injections. But if Lilly successfully commercializes highly effective oral obesity drugs, the company could dramatically expand patient adoption and convenience. This could potentially open the market to millions of additional patients who are hesitant to use injectable treatments. The next catalyst is manufacturing scale. Lilly is investing billions of dollars into new production facilities across the United States and internationally. As supply constraints improve, Revenue growth could accelerate even further because current demand still exceeds available supply in many markets. And beyond obesity and diabetes, Lilly also has a strong pipeline in Alzheimer's disease, oncology, immunology, and cardiovascular treatments. That diversification matters because it reduces dependence on any single product over the long term. Finally, Wall Street sentiment itself remains a powerful catalyst. Right now, investors increasingly view Eli Lilly as one of the highest quality growth companies in healthcare. With strong earnings momentum, massive total addressable market potential, and a long runway for expansion. And as long as execution remains strong, institutional capital may continue flowing into the stock. Of course, despite the incredible growth story, Eli Lilly still faces several important risks that investors should not ignore. The first major concern is valuation. After the massive rally over the past few years, Lilly is now trading at a very premium multiple compared to most pharmaceutical companies. That means expectations are extremely high. And when a stock is priced for near perfection, even a small slowdown in growth could trigger significant volatility. The second risk is competition. While Lilly currently has strong momentum in the obesity and diabetes market, competitors are moving aggressively. Novo Nordisk remains a powerful rival. And several other companies including Pfizer, Amgen, and smaller biotech firms are developing next-generation obesity treatments. Over time, increased competition could pressure pricing, margins, and market share. Another important risk is regulatory and political pressure. As obesity drugs become more widely used, governments and insurance providers may push harder for price controls and reimbursement negotiations. And because these treatments can be very expensive, pricing pressure could become a major issue in the future. Supply chain execution is also critical. Demand for Lilly's GLP-1 drugs continues to exceed supply in several markets. If manufacturing expansion faces delays or operational problems, the company could struggle to fully capture demand. There is also the risk of side effects or long-term safety concerns. Although current clinical data remains very strong, any unexpected safety signal could negatively impact adoption and investor sentiment. And finally, there is concentration risk. A large portion of Lilly's recent growth is heavily tied to the success of Mounjaro and Zepbound. So while the obesity opportunity is enormous, the company's near-term growth story is still highly dependent on continued strength in the GLP-1 market. In short, Eli Lilly has one of the strongest growth profiles in healthcare today. But it also carries high expectations, intense competition, and execution risk that investors must monitor carefully. So, after another explosive quarter, one thing is becoming increasingly clear. Eli Lilly and Company is no longer viewed as just a traditional pharmaceutical company. The company has transformed into one of the most dominant growth stories in the entire healthcare sector. Powered by massive demand for obesity and diabetes treatments, exceptional financial performance, and a rapidly expanding global opportunity. From revenue growth, to margin expansion, to cash flow generation, Lilly continues to execute at an extremely high level. And with products like Mounjaro and Zepbound leading the GLP-1 revolution, the company may still have a very long runway ahead. However, investors also need to remember that expectations are now incredibly high. Competition is intensifying. Valuation remains premium. And future growth must continue justifying the market's optimism. In the short term, volatility is always possible. especially in a stock that has already delivered such a massive rally over the past few years. But from a long-term perspective, many investors still see Lilly as one of the strongest compounder opportunities in modern healthcare. The key question now is no longer whether Eli Lilly is a great company. The real question is, how much future growth has already been priced into the stock today? And that will likely determine whether Lilly becomes one of the biggest winners of the next decade, or a stock that temporarily grows faster than its valuation can support. As always, this video is not financial advice. Please do your own research before making any investment decisions. And if you enjoyed this analysis, don't forget to like, subscribe, and share your thoughts in the comments below.